For 5 years, we watched a mass delusion take over the world. We watched people convince themselves that a mass-produced steel trinket was a better investment than the S&P 500. We watched people humiliated by authorized dealers, begging for the privilege to spend $10,000, convinced that they were financial geniuses because the secondary market was defying gravity. Well, gravity is back, and it is crushing the life out of the Rolex market. The party is unequivocally over. The era where you could walk out of a store with a stainless steel sports watch and instantly flip it for a 100% profit has disintegrated. What we are seeing now isn't just a market correction, it is a complete structural collapse of the arbitrage model that sustained this industry since 2019. Dealers are over-leveraged, inventory is rotting in safes, and the smart money has already left the building. In this video, we are going to dissect exactly why Rolex flippers are panicking, why your investment might actually be a liability, and why the secondary market is currently a trap for the uninformed. Please like this video, subscribe to the channel, and hit that notification bell so you don't miss the truth about the luxury market. The luxury watch sector has entered a profound period of correction as of late 2024 and throughout 2025. But to understand the panic, you have to understand that this isn't just about watches, it's about cheap money disappearing. For years, dealers and flippers were playing with free money. Interest rates were near zero. A dealer could borrow $1 million, buy a pile of Daytonas and Submariners, and sit on them. It didn't matter if they took 6 months to sell because the interest payments were nothing, and the watch was going up in value every single day. That is called positive carry. It encouraged hoarding. That math has inverted. We are now in a high-interest environment. The cost of holding onto that inventory is eating dealers alive. If a dealer is financing inventory at 8 to 10% interest, they are bleeding thousands of dollars a month just to keep those watches in the safe. And here is the killer. The watches aren't selling. We are seeing a massive explosion in days on market. In the glory days of 2022, a dealer would buy a steel Submariner on Monday and sell it by Wednesday. Today, that same watch sits. It sits for 30 days. The dealer drops the price. It sits for another 30 days. By the time it finally sells 3 months later, the interest payments, insurance, and storage costs have wiped out the entire profit margin. This creates a liquidity trap. Dealers are forced to lower prices not because the watch is bad, but because they are desperate for cash to pay their debts. It is a race to the bottom, and it is bankrupting business models that were built for speed. There is another massive myth we need to bust right now. For the last few years, everyone assumed that if crypto went up, Rolex prices would go up. They thought they were connected at the hip. That link has been severed. We are witnessing the Great Decoupling. Bitcoin has surged to new highs in 2025, but that wealth is not flowing back into watches. The crypto bro who cashed out to buy a heavy gold watch to flex on Instagram is gone. The capital driving crypto now is institutional, big funds and ETFs. BlackRock isn't cashing out Bitcoin to buy a two-tone Datejust. The individual investors who survived the crypto winter have matured. They aren't interested in flex culture anymore. They want yield, they want security. They realize that a watch that doesn't pay dividends isn't an investment. It's just jewelry. And so you have high interest rates, you have the crypto money staying in crypto, and you have the aspirational middle class vanishing from the market entirely. The regular guy who felt rich because his house and stocks were up has stopped buying. The luxury market lost approximately 50 million customers globally between 2022 and 2024. Those were the people buying the entry-level models, and now they are gone. This brings us to the most terrifying signal for anyone trying to flip a watch right now. The dealers have stopped buying. In a healthy market, a dealer will always make you an offer. Today, they are refusing stock outright. They are telling sellers, I won't buy your watch. I won't put my capital at risk, but I'll put it in my display case on consignment. If it sells, I take a cut. If it doesn't, you take it back. Do you understand what that means? It shifts the entire risk of the market crashing from the dealer to you. If you maxed out a credit card to buy a watch expecting a quick flip, you are in serious trouble. You are left holding the asset and the debt with no way to get out. Dealers are offering lowball buy prices 30% below what you think the watch is worth, or they are simply ghosting you. There is a massive disconnect between what you see listed online and what watches are actually selling for. This is called phantom value. You might see a watch listed on a marketplace for $14,000 and think, great, that's what my watch is worth. But actual transactions are happening at $12,500 and dealers are only paying $10,500. When you try to sell, that phantom value evaporates and the reality hits you like a freight train. And let's not forget the biggest shark in the tank, Rolex itself. Rolex is not stupid. They saw the grey market dealers making billions off their product and they decided to take that money back. They are squeezing the flippers from both ends. First, they aggressively hiked prices. In January 2025, Rolex raised the manufacturer's suggested retail price significantly, especially on precious metal and two-tone models. They raised the floor while the secondary market ceiling was collapsing. This destroyed the bundle game. Historically, authorized dealers would force you to buy a two-tone watch you didn't want to build a relationship, promising you a steel Daytona later. But now those two-tone watches are trading below retail on the secondary market. Let's look at the Bluesy, the two-tone Submariner with the blue dial. The retail price with tax is approaching $19,000 in some places, but on the secondary market you can find them for around $15,600. If you buy that watch at retail to build a relationship, you are immediately losing over $3,000. That is a terrible financial decision. Second, Rolex launched the Certified Pre-Owned program, or CPO. They are partnering with the biggest retailers to sell used watches that are authenticated and warranted by Rolex. These watches cost way more than the grey market, sometimes 25 to 35% more. Why does this hurt the flipper? Because it sucks the best buyers out of the market. The wealthy guy who wants a Submariner and doesn't care about saving $2,000 is going to buy CPO for the peace of mind. He doesn't want to meet a stranger in a parking lot or wire money to Rolex Flipper 99. The grey market is left with the bottom feeders, the bargain hunters who want to grind you down on price. And recently, Rolex changed the rules to allow watches as new as 2 years old to be certified. This is a direct attack on the near-new grey market. It allows authorized dealers to resell trade-ins immediately, keeping the inventory inside the official system and cutting out the independents entirely. So which watches are the toxic assets right now? Which ones should you absolutely avoid if you care about your money? We already mentioned the two-tone Submariner. It is a guaranteed loss. Demand from flippers has hit zero. Then there is the Yacht-Master 40mm with the slate or rhodium dial. This used to be a hype piece. Now it has lost all speculative premium. Transaction prices are compressing toward retail parity. When you factor in selling fees and shipping, it is a dead asset. The Deep Sea is another victim. It's big, it's heavy, and nobody wants it right now. It sits in dealer inventory for ages, which means dealers hate buying them. Even the safe havens aren't safe anymore. The steel Daytona is still the king, trading at double its retail price, but the premium is shrinking. It has fallen from the insane peaks of $45,000 down to around $34,000. For a flipper, there is still meat on the bone. But for a dealer paying $30,000 to stock it, it's a high-risk hold. A 10% correction wipes out their margin. The only model showing real resistance is the Pepsi GMT Master 2, and that is only because Rolex can't seem to make enough of those ceramic bezels. It's a defensive hold, not a growth asset. And the standard steel Submariner date, the high-volume staple, the margins have become razor-thin. The spread between retail and secondary is only about $3,000. After tax and fees, you might make $1,500. That sounds okay until one package gets stolen, or one buyer scams you, or the market dips slightly. Then you are in the red. The risk-to-reward ratio just isn't there anymore. This financial pressure is causing a shift in dealer psychology. The arrogance of 2022 is dead. Back then, dealers acted like gatekeepers. Now they are desperate. The power has shifted entirely to the buyer with cash. The take-it-or-leave-it attitude has vanished. But be careful. We are witnessing the early stages of dealer insolvency. Dealers who expanded their showrooms and overhead during the boom are now underwater. Some are playing a dangerous game, using money from new consignment sales to pay off old debts. This is a Ponzi scheme dynamic. If you consign your watch to a small, unproven dealer right now, you might never see your money or your watch again. Culturally, the wind has shifted too. Gen Z and younger millennials are rejecting big steel. They are priced out of the housing market. They are aware of wealth inequality, and they view the Rolex flex as cringeworthy boomer behavior. They are moving towards smaller, design-focused watches like Cartier. The Rolex game of waitlists and humiliation doesn't appeal to a generation that demands immediate gratification and actual customer service. We are entering the era of quiet luxury. Overt displays of wealth, like a rainbow Daytona or a solid gold block on your wrist, are seen as tasteless in this economic climate. So what is the future outlook? If you are hoping for a bounce back in 2026, don't hold your breath. The market is heading toward a singularity where the secondary price equals the retail price for most models. Once that happens, the grey market for things like Datejusts and Yacht-Masters effectively dies. Why would you buy a used watch from a stranger for the same price as a new one from a store? You wouldn't. We are returning to the historical norm. The market is becoming a venue for enthusiasts to buy and sell timepieces, not a casino for easy capital gains. For the collector, this is actually great news. The unobtainable is becoming obtainable. But for the speculator, the flipper, and the over-leveraged dealer, the inventory sitting in their safes is not just unsold metal. It is a monument to a business model that has ceased to function. This leads me to a question for you. Given everything we have discussed, if you had $10,000 to spend on a watch today, would you fight the waitlist at an authorized dealer to buy new? Or would you wait for the secondary market to crash further and buy used? Let me know your choice and why in the comments below.